When it comes to investing, everyone chases the flashy, high-profile stocks making headlines. But sometimes, the real opportunities hide in plain sight, quietly growing, steadily gaining value, while almost no one's paying attention. Today, we're diving into one such stock, an under-the-radar gem that's been climbing consistently, defying market noise and investor hype. If you're looking for potential growth without the chaos, this might be the stock you want to watch. Let's uncover why it's quietly becoming a powerhouse. Today we will talk about this stock keeps growing, but almost no one's watching it. So before we start, make sure to hit the like button and subscribe to my channel. 1. This stock keeps growing quietly. In today's market, it's rare to find a company that consistently grows without capturing widespread investor attention. Yet this particular stock stands out for its steady progress, flying under the radar despite solid performance. The company operates in a specialized sector that may not be glamorous, but is essential, delivering products or services that fulfill niche demands. Its growth is reflected in rising revenue, profits, and cash flow, all indicating sound operational health. The stock price appreciates gradually but steadily, unaccompanied by major hype or volatility. This subdued market presence may be due to limited analyst coverage or relatively low trading volumes. The lack of fanfare can be frustrating for some but presents a unique opportunity for investors willing to look beyond headline grabbers and identify fundamentally strong companies overlooked by the masses. 2. Resilient business model. This company's enduring growth is rooted in a resilient and stable business model. Unlike many cyclical firms vulnerable to economic downturns, it operates in markets where demand remains consistent. Long-term contracts, essential services, or recurring revenue streams underpin its financial stability. Management focuses on sustainable expansion rather than rapid, risky growth, reinvesting profits into innovation and customer loyalty initiatives. The company also benefits from a relatively low competition environment, granting it pricing power and margin stability. This approach fosters steady profit margins and positive cash flow, enabling the business to fund operations and growth internally. Despite these strengths, the firm does not fit typical investor narratives, often overshadowed by fast-growing tech startups or industry giants, keeping it out of mainstream spotlight. 3. Strong financial health. Financially, the company boasts a solid balance sheet with low debt and growing equity. Its earnings per share (EPS) have increased steadily over recent quarters, often beating industry averages. Key performance metrics like return on equity (ROE) and return on assets (ROA) confirm efficient use of capital and assets. Cash flow generation remains strong, providing the flexibility to pay modest dividends or buy back shares. The steady growth in revenues comes from expanding recurring income rather than one-off contracts, offering predictability for investors. Transparency in financial reporting and sound corporate governance add further assurance of management's credibility. However, limited analyst coverage reduces the stock's visibility, contributing to its relatively muted trading volumes and subdued investor interest, despite the company's robust fundamentals. 4. A niche market with growth potential. The company operates in a niche but expanding market, often benefiting from broader industry trends like digital transformation or regulatory shifts. It offers specialized products or services that solve complex problems, earning a reputation as a trusted partner rather than a commodity vendor. Strategic contracts with large enterprises or government entities help solidify its foothold. Furthermore, the company adapts its offerings to evolving customer needs, maintaining relevance amid technological changes. Proprietary technology, patents, or specialized expertise create a competitive moat that protects market share. Despite these advantages, the stock doesn't attract mainstream media or social buzz, overshadowed by more glamorous sectors. This invisibility presents an opportunity for investors who focus on deep fundamental research rather than hype-driven momentum. 5. Operational efficiency and discipline. A key driver of this company's success is operational discipline. Rather than scaling aggressively, management prioritizes profitability and efficient growth. Operating margins have improved steadily, reflecting careful cost control and lean processes. Supply chain strategies focus on resilience, mitigating risks from global disruptions. The firm maintains a stable workforce with low turnover, contributing to consistent output and quality. Research and development investments are modest but focused, targeting incremental improvements rather than speculative innovation. This conservative approach reduces risk and supports sustainable expansion. Although this method limits flashy growth stories, it appeals to investors seeking stable returns and lower volatility. The company's operational efficiency underpins its ability to deliver consistent financial results, even in challenging environments. 6. Risks and challenges. Despite its strengths, the company faces risks that might explain some investor caution. Its niche market, while stable, has limited growth potential compared to larger sectors. Dependence on a small number of key clients can expose the firm to revenue concentration risks. Regulatory changes or shifts in customer budgets could impact future sales. Emerging competitors or new technologies pose potential threats, even if the company currently enjoys a competitive edge. Additionally, its low stock liquidity discourages large institutional investors, perpetuating its lack of visibility. These risks require investors to maintain a cautious perspective, balancing the company's stable performance against the possibility of market headwinds or industry disruptions. Diligent research and portfolio diversification are essential when considering this stock. 7. Limited analyst and media coverage. A significant reason this stock remains overlooked is the scarcity of analyst coverage and media attention. Analysts often prefer larger, highly liquid stocks with significant institutional interest, while media outlets focus on popular sectors like tech or consumer goods. Retail investors tend to chase momentum, further sidelining stable but slower-growing firms. This lack of coverage means fewer price targets and analyst reports, which can limit institutional buying and broader market awareness. However, this invisibility also prevents overvaluation and speculative excesses. Investors willing to dig into company reports and industry data may find this under-the-radar stock to be a compelling opportunity. The company's quiet profile, while a disadvantage in terms of market buzz, protects it from volatility and excessive speculation. 8. Strategic growth initiatives. Looking ahead, the company has outlined several strategic initiatives aimed at sustaining and possibly accelerating growth. Expansion into adjacent markets or new geographic regions offers potential revenue diversification. Continuous product improvements and enhanced customer service efforts help retain existing clients and attract new ones. Commitment to environmental, social, and governance (ESG) principles may increase appeal to socially conscious investors. Investments in data analytics and technology aim to boost efficiency and innovation. While management remains cautious, favoring organic growth over risky acquisitions, partnerships or smaller deals could complement expansion strategies. These initiatives indicate a balanced approach, combining steady growth with thoughtful innovation. If successful, these steps could gradually elevate the company's profile and attract broader investor interest over time. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.